Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I offer in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good weekend, all. Ira Epstein of Lynn & Associates with your agriculture update, and this is for Friday afternoon, the 3rd of March, 2017, getting on to the 2:30 time frame in the afternoon. Now, I want to remind you, this is your weekly update. We don't do the daily charts. We're going to do longer-term charts. I do that each Friday for you, and we use a number of different indicators to get into them. So let's talk about what went on this week. It was a funny trading week in the sense that the government, there were rumors that they're changing in the biofuels, the different mandates. They're going to change from the, if you will, the refinery companies that make these blends. They're going to take the burden of the payments that they do for RIN credits and receipts and all and put it on the end user. Then it was denied by the White House. I have no idea what's going on with it, and it's created confusion in the market. So you've had that. You've had a marketplace where today we saw Ms. Yellen have her speech in Chicago, and I think it's pretty much a wrap-up unless something bad happens in the next 2 weeks. Not even that. Today's the 3rd, the 15th is the meeting, that the Fed is going to do what? The Fed is going to raise rates a quarter point, and the market doesn't care. The dollar actually sold off on the news. It's sort of a buy the rumor, sell the fact. You now know where it's at. You can see that the euro is up on the day nicely. In fact, most currencies got some footing. But it is the end of the week, and there's some profit taking. The one thing I'm seeing on the monthly, and the word is monthly, we're going to go to the weeklies in a moment here, is that we're stuck in a triangle pattern in soybeans. Now, it takes a long time, but you can see how this pattern is formed. The way it breaks out is going to be very interesting because that's going to offer possibly a big trade. Now, the word is possibly. You know, you can break out to the top side and immediately go back to the bottom. But ultimately, the way it breaks out and starts that carry through, watch out. That could be the big trade. Recently, the market has been in a slope down where it's gone from 1080 on the weeklies, and this is an area chart of closes only, down to 1013.5, and now you've bounced back to 1027. But that's a down thrust. When I take just the weekly from high to low, I go from 1080 to 1006, the low made this week, and you're 21 cents off that low, but the pattern is that you've broken through some important areas and you're sort of doing that. You see it better on a swing line, which is right here. This is that chart without the swing line, and here it is, and you can see lower highs, lower lows. In order to negate the bear pattern, you have to take out the most recent high of 1063.5 or create some other formation over the next week or two. In order to do it this coming week, that's the only number that negates the bear formation, 1063.5. Where's the battleground happening? I point this out to you each time, and you've got to learn not just what I think, but from other people that use moving averages. Okay, my interpretation of markets is they're always looking after they've made a move. Got what I just said? Because I said it fast. After they've made a move to go back to a number where they can rebuild from for whatever the next thing is that's coming. This is the 18-week moving average of closes. It is over the 100-week. It is said to be in a bullish configuration because the shorter-term average is over the longer term. In addition, prices are fighting right against this right now. That's where the battleground is, 1021.5. Because the swing line is down and prices settled over that 18-week average, the market is neutral. One fights the other. In Bollinger Bands, you had gotten up several weeks ago to the top band. You've now fallen back to the 18-week average to regroup. In addition, should the market break down, you've got strong support at 969 to 67.5, the combination of the Bollinger Band and the 100-week moving average of closes. In momentum, you've been working yourself down, and suddenly you're starting to run out of some of that momentum. But it is still pointing down. As long as the red is under the blue, it's the K line, under the D line, it is still pointing down, but it's gotten to an area where it's pausing in near zero territory. 50 is zero on this type of chart. 80, one way to look at it, overbought. Another way, oversold would be 20. When you go to the meal market, you're falling back with lower highs, lower lows. So the swing line is down, but there's formidable support between the 18 and the 100-day average. And while you're bending down in stochastics, they're not really pointing down dramatically, but the market's drifting with them to the downside, and look for the potential support there. There is no reason here to say you're in an uptrend. You've got swing line down, bias up because you're over the 18-week average. Soybean oil was in a big bear trend, came down, and the combination of the lower Bollinger Band, and you just missed the 100-week average at 31.88, was enough to create a big reversal on this chart. Now, you have not reversed the trend. You've reversed price momentum. The market is right now in an area where the settlement, you're just plain oversold. The resistance is 34.85, and in order to break the bearish swing line pattern, 34.98 is the number that's got to be taken out. So what I think is going to happen, the pros are going to hit the market if it gets up there and see if they can stop it from getting through 34.98 to keep what we call the chart clean. Doesn't mean they'll do what I say, but that's what I think. In the corn market, the weekly corn chart is still bullish. Bit overbought, but momentum still definitely up. The pattern is higher lows, higher highs. It's not a bull setup in moving averages because the 100-week average is over the 18, and resistance formidable at the upper Bollinger Band at 378 3/4. So yes, the trend is up, but each time it's been hitting that upper Bollinger Band, it's like somebody's got four-wheel disc brakes. Bang, they hit it, and it just stops the market from going away. In the wheat market, the trend is up. You've got a pattern of consistent higher lows, higher highs. So while the daily patterns are going all over the board, the longer term is telling you the trend is still up until you take out 412 3/4. The break this week was to 418 1/4. You just missed hitting the 18-week moving average of closes, and you closed back up. So if you even take out this high, this week's high, then the swing line, next swing line, will become this week's low at 418 1/4. Take that out, in other words, go up first and then reverse down, you can get a very bearish situation because it's right against the 18-week average, and it would be under it when the market reopens next week. This 18-week average is going to move higher, not lower. In the cocoa market, you're now climbing back to the point on the longer-term charts where you're losing, getting ready, if you get much of a rally, to lose that embedded reading. Should you get over 2077, what then would happen is you take this whole pattern that's had lower highs and lower lows. It would be broken, and the first potential resistance would be here, the 18-week moving average at 2233. In the sugar chart, this is bearish. The momentum is flat, but trying to roll over a bit. Lower highs, lower lows. I think the pros would sell that market into the 2003. What would get them away from being bearish? Well, taking out the 2100. But until that's taken out, I think they still have their eyes potentially on the lower Bollinger Band. This is a chart that's still on the weekly basis bearish. So is coffee. Coffee market has a pattern of lower highs, lower lows under the 18-week average. Potential target, doesn't mean it's going there, 132.95, let's call it. And to negate this pattern, you've got to take out 150, 140, with the pros probably waiting at that 18-week average to sell into it and see if they can defend their position. You had a late rally this week in cotton that was strong enough to get back over 76.95. So here's how you end a bear pattern. Here's lower highs, lower lows on the swing line. Now, because prices have been over the 18-week average, I would not say one is playing the short side. In fact, I'd say that they're pretty neutral here. Swing line down, bias up, market in a bit of overbought area. Now it comes up, takes out the 76.95, and as you can see, 77.81 is the upper Bollinger Band. You hit 7,800 and you fell back from it. So the resistance is there. Now you're no longer in the downtrend on the swing line. The bias is up, but you are in overbought territory. In the cattle market, you went right on up to the combination of the Bollinger Band, 100-day average, and bang, they just closed the door on it. Momentum turning down. So now this market's void of an uptrend. It's got a swing line that's got no trend. You got a higher high and a lower low. If it closes underneath the 11400 level, it's possible you're going to start even further down. But my guess is the first area of support is going to be that 114.05 level. In the hog market, momentum is turning down. So price is what? Often follows momentum. So this momentum turning down, now you wait to see. If you take out 6602, be scared. The market then will have a pattern where, because the 100-day average, the first challenges of it aren't holding, you might be pulling back to that 18-week to see what the market does. Well, that's how I review this stuff. And what I do for you is in the morning, see this cup of coffee? I ask you to grab a cup of coffee, sit down with me. At 9 o'clock, I have published and is ready for you to view a morning review where I go through 40 charts at a time. I'm backing up what I write at night, where I put out buy here, sell there. And in that video, I'm also going to throw you new trade ideas. And that's how you get your day going with me. And I want to give you a free 20-day trial to it if you haven't had it before. Either call us, go to our website to sign up. Let's assume you've had it. I'm going to give you what we call Ira 20, capital I, capital R, capital A. Ira 20 is a coupon. We were going to stop it already, and we were going to do that around 1, but people are still signing up and take advantage. The coupon gives you $20 off your first 30 days of the subscription, and you can quit your subscription at any time. You're not signing up and you're going, oh, I'm in this for 2 years. A lot of people take it, they go in for 30 days and they go, you know, it isn't for me. Other people go, I've got friends. In fact, for those of you that bring people to us, I have a whole new deal I'm going to give to you, because what better way to get people other than the people that are paying me all the time? They're the ones that love it. So you get my written research, my videos, and if you have a phone and you're in the U.S., my oral updates that come out twice a day. So I do a lot of research, a lot of writing for you. I'm sitting there trying to figure out trades. And the whole idea is this. Can I throw a trade that maybe you were thinking of, give you reasons why, darn it, that's what I want to do anyways. Yeah, I can understand, and now I see something. If you think when I started out I wasn't relying on other people like that, seriously wrong. If you think I don't have a list of top advisors that I don't read, seriously wrong. I want to get their opinions. Maybe it leads me into seeing something I'm not seeing. But at the end of the day, I'm a chartist. And as a chartist, I'm going to bring to you the charts in a way that I think you'll enjoy right at the beginning of the trading day. So with that, I'm Ira Epstein. Call us 866-973-2077. You see our web address there. If you're on YouTube and you want a free trial, that's what this icon is all about. Otherwise, go to the website. Just go under research when you get there to sign up for the actual research. And again, if you've had a free trial, you can't get another one. I'm Ira. You have a good day. You take care.